Hello and welcome to ASAP Trade. Okay, so this week we are going to have a look at the US government bonds 10-year yield. So as you can see here, the US government bonds, the 10-year yield. Okay, pay attention that we're talking about the yield of the 10-year bonds, not the price itself. Okay, so this is the yield chart. So as you can see, in the past almost 30 years, the yield of the 10-year has experienced a massive decline from the highs around here back in 1989, which the yield was around 10%. It has experienced a huge downward movement towards the lows of around 1% in 2016. So for almost 30 years, there was a huge decline in the yield for the 10-year bonds. But at the very end of 2016, right at this area where I'm pointing at, we had a huge development. The US government 10-year yield, for the first time in the past 30 years, broke a major trend line. So as you can see, I have already drawn the trend line, which is in black. You can see it over here, okay? So this trend line is connecting from the highs in 1989 all the way down to 2016 and 17. So you can see multiple lower lows that are connected with this trend line, or maybe better say lower highs. So the lower highs are connected by this significant trend line starting from 30 years ago. So this is a huge, important, massive, strong trend line, which was broken in the end of 2016 and the beginning of 2017. And since it was broken, the trend line was tested multiple times, and at each and every attempt to go back down the trend line, it has failed. So in better words, the trend line was successful in holding the prices above the trend line, or the break was not a false break. So it proved to be a true break. So since then, after the trend line was broken at the beginning of 2017 or end of 2016, we can see over here that an advancement has happened in the past year or so. So we want to have a closer look at this advancement to see what's next for the yield of the 10-year bonds in the near future. What is the short-term outlook for it? As for the long term, because this huge, big, strong trend line was broken, we are expecting that the bull market for the 10-year yield will continue for at least a couple of years or more. But for the short term, we have to have a closer look at this advance in the last year. So let's jump on to a smaller time frame. Okay, so now we are at a smaller time frame. Okay, so over here, as you can see one more time, so this was the all-time low back in June 2016, which was around 1.3%. So since that, we had a rally all the way up to 3.2%. And the most important development, the most important news happened around this area, which I'm showing, okay? It was at late 2016, the beginning of 2017, that this important trend line was broken. And since then, we are seeing an advance in the 10-year yield. And not only the trend line was broken, but it was tested multiple times. And at all of the times, the broken trend line was successful in supporting the prices towards the upside. Okay, but as I mentioned, we want to know what will happen in the short term. The first thing that I wanted to show you is the MACD, which is one of the most important indicators we have. Okay. So if we open the MACD, and let me expand it a little. So you can now see here that a divergence is happening. So if I draw approximate trend line here, another one here, you can see a divergence happening for the in the MACD. So as you can see, we had multiple higher highs over here, okay? But when you look at the corresponding areas of these higher highs in the MACD, which is here, you can see that each higher high was accompanied by a lower peak, a lower high in the MACD, to which we call this a divergence. And in fact, it's a triple divergence because we have 3 higher highs along with 3 lower highs in the MACD. So this by itself can be a major development in the short term for the yields of the 10-year bonds. This by itself signifies that probably for the short term, the advance in the 10-year yields is over. And from now on, at least maybe for the next weeks or months, we will see a downward movement for the 10-year yields. And I'm expecting that the 10-year yields will break back below the significant psychological 3% level. So if around here is the 3% level, most likelier than not, we will see a dip below the 3%. As you probably know, the 3% level is an important psychological level. So if we go back down the 3%, it's probably would happen that the yield will extend the decline towards maybe 2.8% or even 2.7%. And indirectly, when the bond yields go down, it can mean that probably we will expect some US dollar weakness to be seen with. So probably when the 10-year yields go down, the US dollar will also weaken. So this is something that I'm looking for, I'm monitoring for. So, and something else that I wanted to share in this chart is the Elliott wave pattern. If you look back from the lows of around September 2007, which was the last time that the trend line was tested, to the highs over in October 2018, you can see a like familiar Elliott wave pattern happening here. You can easily count this advance. Let me change the marker. Okay, you can call this advance up to here as the wave 1. So from the low here to high here is the wave 1, and then we have wave 2. Then we can count this advance, this huge substantial advance, wave 3, and then a correction as wave 4, which has bottomed in this area, and finally a wave 5. So you can see over here that this most recent advance starting from September 2017 till 2018, so like at the current time, this looks like a 5-wave advance. And what happens when a 5-wave advance is over? We have a correction. So based on the MACD and based on the Elliott wave patterns, it seems that the correction in the bond yields are due, and probably most likelier than not, the prices will go down below 3% before they resume the uptrend. Remember that this is only the short-term analysis of this chart. For the long term, because we have broken this major and important trend line, which I'm marking here, the overall outlook for the years to come is a bullish outlook. So most likelier than not, we will see higher yields like in 3-4 years. But for the very short term, probably till the beginning of 2019, the yields will go down, which, as I mentioned, can indirectly imply that US dollar will weaken too. So expect maybe higher prices in gold, maybe higher euro to US dollar, maybe higher commodities. So this can happen in the next few months. So I hope that you have enjoyed this video, and you can see how technicals can be helpful in analyzing a chart. So I hope you enjoyed it. Thank you very much. And that's it for today. Have a great time. Bye.